Good morning and good afternoon, everyone. Welcome to this virtual press briefing on the end of Libor and what it means for derivatives markets. My name's Joel Clark, Director of Communications at ISDA. And while we're still in the midst of a pandemic and so we can't meet in person at this time, we felt it was a good time to bring you together to brief and discuss this critical topic. Let me start by introducing our panel, who will be familiar to many of you. First of all, we have Scott O'Malley, ISDA's CEO. Joining Scott is Anne Battle, Head of Benchmark Reform at ISDA. And finally, we're delighted to welcome Jason Granite, Managing Director and Head of Libor Transition at Goldman Sachs. Scott, Anne, and Jason, thanks very much for joining us. A couple of quick housekeeping points. The briefing will be held on the record, so you're welcome to report on any of it, and the ISDA communications team will be at your disposal for follow-up afterwards. Following brief opening remarks, we'll turn to Q&A, and you can ask your questions by inputting them into the box on your screen. They'll come directly to me here, and we'll try and get through as many of them as possible in the time we have. Now, to get things going, I'm very pleased to introduce Scott O'Malley. Scott, over to you.
Thank you, Joel. Hello, everyone. Thank you very much for joining us today. We now have clarity on the timetable for Libor's future. We know that firms have 9 months until 24 Libor settings completely cease and another 6 become non-representative. We know 5 US dollar Libor settings will continue to be published until the end of June 2023. Now, 9 months really isn't all that much time, so firms need to move ahead with the transition of their legacy Libor trades and increase their use of alternative rates. Even for the US dollar Libor, US regulators have made it clear that US regulated entities should not use this rate for new trades after the end of 2021, except in a limited circumstance. So firms need to prepare for alternative rates, at least for most new trades after the end of this year. There's also an increased trading in these alternative rates, but there's still some way to go on this front. According to the new analysis by ISDA and Claris, 45.7% of total cleared OTC and exchange-traded sterling interest rate derivatives, DV01, was linked to SONIA in February. However, just 5.1% of cleared US dollar interest rate derivative DV01 was referenced to SOFR in February. Fortunately, the derivative market now has a safety net in place in the shape of a new fallback. While these fallbacks are in place, market participants can press on with the transition, safe in the knowledge that a workable backup will take effect for their derivative exposure if they don't transition all of their outstanding trades in time. Now, I'll leave Anne to speak a little bit more about the fallbacks and see how they've been affected by the FCA comments. Anne, over to you.
Sure. Thanks, Scott, and thanks, Joel. So as many of you know, fallbacks took effect for new and legacy IBOR derivatives on the 25th of January of this year. So by taking effect, that means that contracts that incorporate the fallbacks have the fallbacks as the rate that will apply if and when there is a cessation or non-representativeness of the relevant IBOR. So in Libor, we actually have those dates for when the fallbacks will apply, as Scott explained. As I think many of you also know, the fallbacks are based on risk-free rates, so SONIA, SOFR, etc. But the risk-free rates are adjusted, including using a spread adjustment to reflect a portion of the structural differences between Libor and the other IBORs and the risk-free rates. This spread adjustment, as we've been talking about for several years, is meant to reduce the chance of contracts originally based on an IBOR diverging too far from counterparties' original expectations after the fallbacks actually apply. And as I think a lot of you also know, we spent several years engaging in global market-wide consultations to produce the formula for the spread adjustment. The spread is fixed at the point that the relevant IBOR administrator or regulator announces that the IBOR will cease, or in the case of Libor, the FCA announces a setting is or will be deemed non-representative. So again, this is what happened on March 5th of this year. Given that the FCA's statement on March 5th covered all 35 Libor tenors in one way or another, the spread adjustment for all settings was fixed on March 5th. Those spreads are available in the press release that Bloomberg put out on that day, which is accessible via the Bloomberg website or on the ISDA website. And just to quickly level set, in case necessary. Bloomberg published that information because Bloomberg is the vendor that ISDA selected to publish the fallback rates. So derivative markets since March 5th have more information about the fallback rates that will actually apply across all currencies and tenor for Libor, which hopefully helps with transition planning. We did see since March 5th a slight uptick in adherence to the IBOR fallbacks protocol, potentially driven by that increased clarity. If you haven't checked, we have over 13,500 adherents to that protocol as of the last few days. So the fallbacks themselves will apply for Euro, Sterling, Swiss franc, and Yen Libor on the first London banking day on or after January 1st, 2022. So that's expected to be January 4th, 2022, unless that's an unscheduled holiday. For all outstanding derivatives that continue to reference US dollar Libor, the fallbacks will apply on the first London banking day on or after July 3rd, 2020, or after July 1st, 2023. So that's expected to be July 3rd, 2023. And so those are the two critical dates, even though within the FCA's announcement, different tenors are treated differently.
Great. Thank you, Anne. Thank you, Scott. Jason, can I hand over to you to give your perspective on where we are?
Yes, sure. Just some high-level comments on some of the things that Scott and Anne shared. Number one, I just want to highlight that ISDA's been a central, pun intended, clearinghouse for getting everyone together and thinking through fallbacks over many years, working across official sector, buy side, sell side, end users, market makers, you name it. They've been the consultative process across thinking about this has been unbelievably substantial and very, very thorough. And then the last thing I want to highlight is that there's been a lot of collaboration between private sector and public sector on this more broadly, whether it be the national working groups, whether it be ISDA, whether it be other industry bodies. All the central banks globally have put together some form of a forum to bring people together, and the dialogue and collaboration across both private sector and public sector has been very strong to get the market to a very safe, smooth transition over the dates that Anne just laid out. And I think that that's an important thing, broadly to understand, is how collaborative and coordinated it's been to make this as smooth and as least disruptive as possible. But other than that, Joel, I look forward to hearing all the questions from the team here.
Great, thanks, Jason. And a reminder just to keep those questions coming in. We will get through them as you send them. But in the meantime, I have a few questions. Anne, maybe we'll start with you, just picking up a couple of the things that we've discussed already. We're at this point now, as you and Scott alluded to, that we have clarity on the timetable for Libor, the end of Libor. But at the same time, we now have fallbacks in place for most Libor derivatives exposures. And as you said, Anne, more than 13,500 firms now adhere to the protocol. And this allows firms to incorporate the fallbacks into existing IBOR derivatives contracts with other adhering parties. The UK FCA has published an analysis that showed over 85% of non-cleared interest rate derivatives in the UK referenced to sterling Libor now have effective fallbacks in place because both counterparties have adhered to the protocol. So some might think, listening to that the hard work's done, we're nearly there. Why might that not be the case?
Sure, thanks, Joel. So firms really need to think about actively transitioning their portfolios and the use of alternative rates for new trades. So having the robust fallbacks is a vitally important step, and it does go a very long way to mitigating the risk that Libor is discontinued or becomes non-representative and derivatives don't have a rate to reference. But to use the somewhat overused metaphor, it is a safety net, and fallbacks are not intended to be a primary means of transition. you may have seen recently that CCPs are considering active transition plans that would actually move to the OIS conventions for these risk-free rates. And I think that's certainly something that, to the extent it's possible, market participants should consider for their non-cleared portfolios, and should potentially consider using the additional 18 months for US dollar LIBOR to consider active transition.
Jason, anything to add on that?
Look, I think at a high level, there's a lot of momentum here. More broadly, I'm sure Scott can comment on that, but more generally, when you're seeing all the people put these safety nets in place, it only makes sense to continue to put safety nets in place. There were definitely a lot of contracts that existed prior that don't have the right clarity. And so ISDA's done a very thorough job with the market to make sure that now everyone has the tools to have clarity on their contract. And so it only makes sense to take up the opportunity to clarify your contract. That does not mean that you then have to live through the event as described in the ISDA definitions, but it puts you in a safer position, and then you can go appropriately discuss and negotiate with your counterparty the right thing thereafter. But most importantly, the market has come together to provide the tools to create certainty in your legal contracts, especially in the context of derivatives. There's no reason that shouldn't be taken up.
Okay, great. So I'd like to kind of look at the bigger picture now and come to some of the developments we've seen just in the last couple of days. Scott, maybe I could ask you, we talked a bit about the split timing, the mid-2023 end date for most US dollar LIBOR settings. Do you think that will dampen momentum in transition?
I think there's a number of things, and Anne and Jason have alluded to it. There is a massive momentum underway here. We have a number of factors going for us. First of all, we have all the LIBOR settings in euro, sterling, yen, franc, and many of the US dollar LIBOR settings are either going to cease or become non-representative at the end of this year, right? There's a few that will continue on into 2023. U.S. regulators have definitely signaled the end of writing new trades for LIBOR after 2021. And then finally, by the end of 2023, so many of these other legacy US dollar LIBOR trades are going to be rolling off. Let's also keep in mind that we have PAI and discounting for CCPs that have switched over in October of last year. We have 13,500 entities that have adhered to the protocol, adopting effectively risk-free rates into their books and off of LIBOR. We have the regulatory pressure and all of these settings going away. So I think these items really contribute to the kind of a momentum that is irreversible in this direction. And LIBOR's days are numbered.
So yesterday, the Alternative Reference Rates Committee in the US published its latest progress report on the transition to US dollar LIBOR. And that report estimates that the use of US dollar LIBOR has actually increased. Let's start with Anne. Anne, do you think this is a concern?
It certainly is something that needs to turn around this year. I think one thing that is noticeable about the report that the ARC published is that a lot of that increase is in derivatives and in both cleared and non-cleared derivatives. So for cleared derivatives, the fallbacks are in place. And as I mentioned, the CCPs are actually planning as of specific dates to transition away from LIBOR. So while there is LIBOR exposure, the risk of that LIBOR exposure continuing past the date on which LIBOR ceases or becomes non-representative has very largely been mitigated. So we don't have exact numbers, and the ARC didn't produce exact numbers, but I do think if you looked at the percentage of that US dollar LIBOR exposure in particular that doesn't have good fallbacks, it would paint a quite different picture.
Yeah, I looked at some quick numbers, recently, and if you look at the activity of either exchange traded or stuff that has robust fallbacks, either through the ISDA process or other thing else, that stuff is way outpacing anything. And if you look at LIBOR use in cash markets generally, it's basically flatlined, especially since the beginning of this year. The curve has flattened very, very significantly. And so derivatives have all the tools and equipment in place. And so there's reasons that people may continue to use LIBOR, but they're doing it in a much safer way from a legal contractual perspective than in years past. And so, that's an important point to note in the numbers. And the other thing that we're seeing when we looked at the numbers is there was a massive spike in RFR activity, especially SOFR in the fall around the discounting change. We actually have another discounting change this weekend with the LATAM businesses moving to SOFR discounting and other things. And so when the clearinghouses change the underpinning of that, it's really increased activity. And even when you've had pullbacks because of seasonality, so you had spike in October, early November, and then over Thanksgiving and Christmas, obviously you'd expect volumes to go down. And the beginning of the year, you had activity go up. You're seeing on the charts, the lows, the cycle lows are higher every time. So you have things moving up, pretty in pretty strong fashion, which is a good story. And then if you not just look at what was published by the ARC yesterday, but the ARC had a symposium where there was lots of speakers, one of which was Vice Chair Quarles. He was pretty poignant in his comments around the direction of travel and the direction of travel for on where examiners and supervisors are going to be. And so I think the message, broadly is reasonably clear, and all the tools are in place for people to move forward in a safe way as well.
Great. Thank you, Jason. And just a reminder to keep sending your questions in. I can see that they're stacking up, and we're going to start tackling those. But I just have one more question on recent developments. And even since yesterday, the ARC has today put out a statement about term SOFR, saying that a term SOFR rate is unlikely to be ready for use in the near future. And can I ask you, among what type of market participants is the demand for a term rate strongest? And what challenges might this delay cause?
So the term rate, as I think has been very clear from the ARC and other regulators, was never intended for primary use in the derivatives market. And in addition to policy reasons for that position, I think there's some very clear structural reasons, and that's because a forward-looking term rate is based on derivatives trading in SOFR. So without a derivatives market that is not based on the term rate, you just de facto cannot have the term rate. And so, therefore the demand for it is a little bit outside of ISDA's space, but certainly throughout this whole process, we have coordinated very closely with our counterparts in the cash markets. And we've certainly heard the demand for some type of forward-looking rate from the loans market. And we followed that closely to the extent that derivatives would hedge those loans. So I imagine that is the sector generally that's focused the most on yesterday's announcement.
Okay, thanks. So we've got right down into the weeds, as they say. Let's pare it right back and ask a more broad general question. And Jason, let's come to you. What is the number one challenge for market participants in advance of the end of 2021? As someone who's heading LIBOR transition at a large bank, I'm going to ask you for number 1 and 2 and 3.
Yeah, sure. So I would say in years, look, we've been working on this for many years. I'd say the biggest challenge to this point has been getting contractual terms in order and understanding contractual terms. As far as I'm concerned, that was kind of phase 1, big focus, understanding the terms, and ISDA's been central in coordinating that, as I indicated, with the multiple consultations, the fallback language. That's obviously also happened at the ARC level, rolling out best practices language and other working groups nationally. I would say now we're moving over to the operationalizing aspects of it. So we have protected ourselves contractually, and now we have to execute what's in the contracts. And so I would say the shift from both all different types of market participants has gone from getting the terms right to moving over to operationalizing said terms. And so, broadly from a market perspective, this is where the focus is. We feel comfortable at Goldman that we're positioned well to handle it from that perspective, as we've been focusing a lot on these operational details. But you can see this in plans that are coming from LCH, plans that are coming from CME, other plans that are coming out of cash market recommendations from the ARC and others, is that we have good docs, we have good contractual terms, we now need to execute them, and that's going to play out in most places at the end of this year, and then 18 months after for dollars.
And let me put another question to you. Could a delay to dollar LIBOR's end date give firms pause in signing the ISDA protocol, given the fallback spread won't come into effect for another 18 months after the end of this year?
Right. So as mentioned, the fallbacks for US dollar LIBOR won't apply until the middle of 2023, as opposed to the fallbacks for the other currencies. So I guess to answer the question literally, it could give firms reason to delay, but I think we want to emphasize that it really shouldn't. The overused metaphor is that the fallbacks are the safety net, and what really makes sense is to have that safety net in place so that you can then determine if you want to do something more bespoke with your derivative contracts that reference US dollar LIBOR. Look, I think there's some practical reasons and just some market-driven reasons. These fallbacks are in place for cleared transactions. They are in place for the transactions among those who have adhered to the protocol, and they are actually the rate that applies if you do choose to continue, or the fallback rate that applies if you do choose to continue using US dollar LIBOR. So from a market perspective, if you don't have that fallback rate, you inherently are using what's going to become a very bespoke US dollar LIBOR contract. Additionally, as we haven't really gone into, but ISDA started work to put these fallbacks in place actually in 2016, a year before the 2017 announcement. And that's because the current fallbacks are to a reference bank poll that is unlikely to give you a result. So if you think that today you have a fallback that might match your cash product and adhering to the protocol would give you something different, I think it's really important to understand that actually you don't have that today. Today you have a fallback that likely wouldn't give you a rate. And so moving to a fallback that would give you what has become the market's standard rate is, as Jason said, a really important first step.
Thank you, Jason. Sorry, Scott.
To the point, will they delay? And we'll see how it plays out. But I just think from a perspective of kind of where the regulators are going to be spotlighting this, and the focus, as Jason has said, the contracts are known, the benchmarks are there, the fallbacks are there. People understand what's going on. That the focus of everybody's attention now will be on these last little bits and transition. And I do think that SOFR liquidity is going to be rising. It has been rising slowly, but it will continue to rise. And the regulators are going to be watching this, and they're going to be pushing pretty hard going forward to make sure everybody transitions out of this. So there is an inevitability to all of this.
Yeah, on the idea of a delay, I'll just quote from Vice Chair Quarles yesterday, reading word for word here. Quote, "There is no scenario in which a panel-based USD LIBOR will continue past June 23, and nobody should expect it to." So those were his words. And I think the market, heard them pretty loud and clear yesterday.
And Jason, a related question on timing. We're about a week out now from March 31st, which has been set as a deadline to cease new sterling LIBOR trades. How realistic is that deadline, and what steps would you say dealers need to take to ensure that any client sterling LIBOR trades they enter into are actually risk reducing?
Yeah, I think that dealers and the UK market's been focused on this for a while. I think it's very realistic. Scott walked through some of the Claris data that he tracks on his end, where you've seen a massive uptick and depth in the SONIA space, and so that market has had very strong movements in transition for a long period of time. So I think this is an inevitability as opposed to a difficult thing to deliver on. I think the market in the UK is gonna handle it in a reasonably smooth fashion.
And Anne, you touched on this earlier, but we just had another question come in on the ARC and the report that US dollar LIBOR exposures have actually increased. I know you touched on this, but perhaps just to go over again, why is that and what can be done about it?
So I think we did touch on the ARC report. While it doesn't answer the question about what can be done, I mentioned that it's important to point out that almost all of that increase in the derivatives market does have the more robust fallbacks. And so the risk has been mitigated. And, we used to say that once these fallbacks were in effect, everyone that had the fallbacks had contingent exposure to the risk-free rates. And so that meant that the numbers for SOFR, on the other hand, were actually higher because there was this contingent exposure. Now that the dates for the application of the fallbacks have actually been upset, it's no longer contingent exposure. It actually means that a great deal of that increase in US dollar LIBOR exposure actually is exposure to SOFR. So from an economic or market perspective, you can look at that as SOFR exposure, which I think will hopefully give people more confidence in moving to exposure. All of that being said, it's ideally, it's not optical, or it's not ideal from an optical situation that these numbers have increased. But I think if you look at the immediately preceding few months and some of the data that Jason described, the story today is moving in the right direction.
Jason, do you want to add your perspective on that?
Yeah, sure. I would, if you look at what's going on, for example, in the Ionia ester markets, it's been pegged. And so even if you see Ionia activity go through the market, it really is ester activity. The movements in ester are the only thing that can affect the value of Ionia at this point. Some of it is because system and processes uplift are still going through, et cetera. And so now, you had asked an earlier question around, now that we have these March 5th announcements, what does that mean broadly? It touches here as we know exactly what the math will look like from certain dates forward, depending on the currency. Those dates are different. And so if you're trading a long dated transaction, you essentially only have exposure to SOFR, the underlying RFR, for that period because the math is known otherwise. And so this comes back to my other point, is that the markets now migrated their focus to the operationalizing and focusing on making sure that they can process everything using the new terms, new words, new inputs, new world. And there's been substantial progress there. At least the folks we interact with are quite ready and getting there, but the market in aggregate is spending their time and attention on that. And so one big help from the official sector is when they gave clarity to those numbers, they've created the value is now known. And so therefore, it's a lot easier to understand and manage accordingly.
Okay, so Scott, can I come back to you on, you mentioned in your opening remarks the Claris figures on SONIA and SOFR liquidity, and the fact that SOFR is obviously SONIA is obviously somewhere ahead of SOFR at the moment. What needs to happen, do you think, for liquidity and the new RFRs to increase? Are you concerned at this point that the market may not be liquid enough?
Well, this is a question we've been asking, I think, from the very beginning, and now, which is why ISDA teamed up with Claris to ask the question. Let's monitor and track this. Let's follow this so we have better data. It's always been a bit of the chicken or the egg. Is it liquidity or is it going to be issuance? I do think it's going to be issuance now. I think that's the key issue that's going to be driving it. Each currency and each, SONIA is different than SOFR. We know that. We've seen just in the age of it, right, and how long it's been trading. So, we do understand that there's going to be idiosyncrasies here. We are watching this very closely, but I do think that the more issuance that really come in to play here, the more liquidity that's going to drive this. As I noted earlier, there's a lot of items in momentum, whether it's the PAI and discounting, whether it's having the fallbacks and having exposure, as Anne and Jason have both said. But I think it's gonna pick up, and it's gonna pick up significantly as we get closer to the date. Maybe it's a bit like my homework assignments. I never really got down to getting them done well beforehand to make my life easier. I always kind of delayed. That could be where the market is here, but I'm gonna make a guess, and I'm gonna say it's going to be issuance driven.
Yeah, and to Scott's point, over the last 2 weeks, you've seen two bellwether issuances in the U.S. Both Verizon did a very large financing and had SOFR tranches to their financing. AT&T did a very large financing and they had SOFR tranches to theirs. And so, one of the questions that continues to be asked is, when are you going to get participants, from that sector of the market? And unsurprisingly, since March 5th, we've now seen that. And so I would expect that to continue to tick along and pick up. If it's like anything else, it'll build upon each other, and we'll see substantial movement. When we come back in the summer or in the fall, I think people will look back and see charts moving substantially quickly.
So one more question on rates and liquidity, and then we'll move back to deadlines and enforcement. So we've talked about RFR liquidity, but it's obviously not the only alternative. A variety of alternative rates have sprung up, including some with a credit spread component, which is meant to reflect the dynamics of bank lending markets. And do you think firms will want to use more than just RFRs?
Yeah, so from ISDA's perspective, we're certainly agnostic on alternative rates that are ultimately used, whether it's in new transactions or in privately negotiated fallbacks or transition arrangements. So I think it is clear from the work of the ARC and the other risk rate working groups that the risk-free rates are arguably most suitable for the majority of derivatives trading. Other rates, including rates with a credit-sensitive component, may be more appropriate in other cases, even in the derivatives market, if those rates are used in a cash instrument and a derivative is used to hedge that instrument. So we certainly think firms should be looking into this, should be looking at their portfolios and their individual needs, and should opt for whatever rate best meets those needs. Just to give a little bit of color on the work that ISDA has done in this regard, we published a rate option to allow counterparties to trade Ameribor derivatives, and we currently have a rate option in process to allow for trading in BSBY. And we've been in communication with the administrator for other credit-sensitive rates and plan to facilitate trading in all of those rates so that to the extent these rates are more appropriate for certain market sectors, they are absolutely hedgeable.
So coming back to what lies ahead, and Scott, I'm going to start with you on this one. Private and public sector the private and public sector have been working well together, as you well know, having been part of that, to prioritize the end of 2021 transition. Do you expect the regulators will be moving to a more reactionary enforcement position from January 2022?
I don't think so. I think they have achieved what they've come for, right? And it's been driven by transparency, a lot of good forecasting in terms of what people can expect. And I think the ARC deserves credit for, kind of giving the market what it needs going forward. Even if it's sometimes bad news, they may have, said, hey, we want a term structure, but they said, hey, this is the timing you can expect on a term structure, and it will not be at the next 6 months. It may not even be the end of the year. But I think the regulators have been extraordinarily well linked up. They've been pushing forward and been very clear about what it is they want and the timetables they want it. So I think we're making good progress on this, and I would think that we can continue on this path of good cooperation, a lot more transparency, and being clear about expectations. And the industry is working extraordinarily hard to deliver on its end, right? Driving liquidity, communicating, concerns and issues that various products may have, and raising those and resolving the problems the best we can. And I think the regulators have been accommodative, and we're making good progress. I don't think anybody should be under any illusion that these dates are going to be moved, so they should plan accordingly. But we're all on notice, and they've been consistent. So we shouldn't expect changes in their behavior or expectations.
Jason, I'm going to give you an opportunity to comment on that because I imagine it's something you've given some thought to, but also another question that's come in, which is how big an operational challenge is the year-end cessation date, given that fallbacks would all trigger during the year-end code freeze period?
Sure. So first on the last, just to provide a little bit more color on the last one, if you look at the Fed's release on November 30th, you look at the Fed's release, I guess it was, I lose track of time, but the week before last, their SR 21.7 that came out shortly after the March 5th announcement. And then you look at Vice Chair Quarles' comments yesterday, this consistency across all three. These are now his words, quote, intense supervisory focus, end quote, use of new LIBOR in contracts would create safety and soundness concerns, end quote. And so, to answer the question on regulatory focus and where the official sector stands, I think that those words, kind of sum that up. And those words show up in not just his speeches, but also in the releases going back to that Monday after Thanksgiving. On the second question, the operational lift, there's been some thoughts, especially by the clearinghouses, about the end of the year, and which is why LCH and CME and others are thinking through plans and progress that would do some transition earlier in the year, sometime between Halloween and Thanksgiving timeframe. It's still being discussed and thought of, but there's recognition that the end of the year has other complications, with the holidays and financial reporting, other things. And so, the market and market participants and industry working groups are working together to make that as safe and smooth as possible. And, at the very beginning, I commented that there's been great collaboration between market participants, official sector, private sector, clearinghouses, trade associations, et cetera. And this is just another version of everyone, working very well together and trying to get this to be as smooth as possible. I mean, when you look at the amount of trades in the numbers, there's a recognition that there needs to be a transition of a substantial amount of trades and financial contracts. And so everyone's intention and goal is to do it in the smoothest possible way. And given where it falls on the calendar at the end of the year, you'd see some of the clearinghouses and other industry groups leading discussions in bringing that forward and figuring out the appropriate mathematics and processes to make that work in the right way. But I feel good that the right conversations are happening to figure that out in the most safe way for all participants.
So, Anne, coming back to the questions around term SOFR and the ARC announcement that it won't be able to provide term SOFR, or it doesn't expect to mid-year or even potentially end of year. Would the introduction of a term Ameribor rate have a damaging impact on SOFR transition?
So look, I don't think that is going to have a damaging impact. I think it is, again, as we mentioned, it is really helpful that these different rates are popping up for market participants who need something that's not offered by SOFR or not offered in some cases even by a forward-looking term SOFR that may exist in the future. And so it's helpful to those market participants, but the market participants who should be transacting in a compounded version of SOFR or some other version of the published SOFR aren't really the market participants who are looking for something like a forward-looking term Ameribor or one of the other credit-sensitive rates. So I think the two groups are distinct, and I wouldn't view that as having a negative impact.
So one of the areas we haven't touched on yet is tough legacy contracts, those contracts that are challenging or difficult to transition. And there have been different approaches taken to this question about what to do about tough legacy contracts. In the UK, the FCA has said it will consult on using its powers under the proposed Financial Services Bill to require the IBA to continue publishing 1, 3, and 6 month sterling LIBOR on a synthetic basis for a further period after the end of 2021. And 1, 3, and 6 month yen LIBOR on a synthetic basis for an additional year after the end of 2021. It's also said that it will consider the case for requiring the IBA to continue publishing 1, 3, and 6 month US dollar LIBOR on a synthetic basis for a further period after the end of June 2023. I guess the first question is, why can't firms just carry on using that rate?
Sure. I mean, happy to take that. I mean, one technical point is that because I think the key aspect of those potential plans from a derivatives perspective is that the synthetic rates will be non-representative. And as we mentioned at the beginning, our fallbacks are triggered by the rate becoming non-representative. So in the derivatives market, you will not see any new use of that rate because as a very technical matter, your contract would automatically go to the fallback rate. And once these rates are published, to the extent you have the fallbacks, you would be moving to the fallback rate. The ARC also mentioned the possibility for these synthetic rates in the symposium yesterday and made it very clear that firms, particularly in the U.S., should not depend on those. There's separate legislation being considered at both the New York and the federal level to address tough legacy exposures, and there's legislation in other jurisdictions. So I think it all remains to be seen how these different legislative pieces will work together. But I think for derivatives, it's very clear that utilizing contractual fallbacks, or even better, actively transitioning, is the correct approach. And for those products that truly are tough legacy and cannot be amended, which is going to be primarily, if not exclusively, outside the derivatives market, I think it's a huge step in the right direction that these tools are being considered.
And Jason, there will be a consultation on this, right? The FCA is going to run a consultation on synthetic.
That's correct. So the powers that the FCA would be using to compel IBA to publish any type of synthetic LIBOR would be under its proposed new powers under the Financial Services Bill. And they have indicated that they will consult on the publication of a synthetic LIBOR for certain sterling and yen tenors, and that they are considering the case for the publication of synthetic LIBOR in certain US dollar tenors, and any consideration they would give would include a consultation.
Jason, what's your take on the tough legacy question? And specifically, do you think that the 2023 deadline for US dollar LIBOR provides sufficient time for market participants that may be facing tough legacy?
So let's take those two things separately. The first thing is very early on, Ann and I sit through all these ARC meetings. Very early on, there's been extensive discussion around navigating the tough legacy appropriately. And that's why the ARC has been very focused on different legislative solutions. That's why you've seen the UK come out with their plans for legislative solutions. You've seen legislative solutions proposed in Europe and other places. And so there's a wide recognition that there needs to be a tool in place to deal with the tail of legacy securities. I shouldn't use the word securities. Legacy contracts is probably a more appropriate way of describing them. So first thing is people should have comfort that this has been on top of mind for a very long time, and the amount of resources that have been committed at the industry from the both private and public sector perspective has been substantial to think about this. On the flip side, there's a hyper focus to pin down what exactly belongs in that bucket, and for everyone to go sign their protocols or do their bilateral amendments, get yourself into appropriate fallback language, renegotiate and migrate as quickly as possible. And so that we can really pin down, we, the industry, and public-private sector in aggregate can pin down what is actually the true tough legacy. And so that gets into the 2023 question that you raised for dollars. What it does do is the combination of no new LIBOR use after the end of this year and then 18-month window will allow two things to happen. Number one, it will stop the production of new stuff. Number two, it will allow a significant amount of things to mature. I think it's, close to half or more. I forget the exact numbers. Ann might even know the numbers. And then it will also allow time to clear the deck to see what's really left at the end and to work through it in whether legislative or other solutions. So quite frankly, if you take a step back and look at it from the blimp and look down, it actually provides some good timing, space, and opportunity to diagnose the market and get to the right solution at the right time for different participants. And it lets the official sector properly evaluate and lets the private sector appropriately come forward with what needs to be solved to work together, as has been to happen to do that over time. And so, quite frankly, I think it's been quite sensible and well thought out in the way it's been collaborated across the market to think through this.
Well, we're nearly out of time. We've covered a lot of ground and I think got through the majority of questions that have come in. I'd like to just use the last few minutes to ask each of you, given the tight timeline, the deadlines that are coming up end of this year, mid-2023, what are the next steps? What should firms be focusing on? Scott, I'm going to start with you.
Well, I thought Jason did a good job of spotting the question earlier on. It's about getting your contractual house in order, and then it's dealing with the operational. And for some, it will also be about dealing with the tough legacy issues. So it is really about getting into SOFR, particularly in trading those risk-free rates if they haven't done so, and begin to move that liquidity over. Again, there's not going to be something at the end that comes to rescue you and gives you Libor back. That is, Libor's days are numbered, as I said earlier. So don't expect that to come back. Now it's get your arms around SOFR and SONIA and the other risk-free rates, depending on the jurisdiction you're in, and then begin to solve for that problem.
Yeah, so I agree with everything Scott said and want to emphasize one point, and that is to trade the risk-free rates. I mean, of course, if you don't have the fallbacks yet, that is really, something you should have done yesterday. So get those in place. But what you really don't want from an operational perspective is for the first time that you have exposure to SOFR or SONIA to be the date on which the fallbacks take effect. You want to ensure that your operations and your systems can handle those rates prior to the fallbacks coming into place. So I would use the time to get all of that squared away.
And Jason, finally.
Yeah, I mean, it's game time. Here we are, 2021. So, I think what Scott and Ann have highlighted completely appropriate. Make sure that you know what you have and have a plan for what you have, and understand what the choices are for the stuff that's left after that. And so we've been talking about this for many years, but we are, and all importantly, all the tools are broadly in place. And so the private public sector partnership has been unbelievably collaborative to put the tools on the table for folks, and now it's time to go and execute all of that. So it's here we are.
Well, Scott and Jason, thank you very much for making the time today. It's been a really useful briefing. I hope that our journalists attending have found it useful. Thank you for all your questions. If you have any follow-up questions, the ISDA communications team are at your disposal. Our contact details are on the website and popping up on your screen now. So please do get in touch. This is obviously a live issue that we'll be continuing to work through, and please do contact us if you need comment or guidance on your articles. And with that, I will close. Thank you very much for joining us, and have a good day.
Thanks, Joel, and thanks everyone for joining.
Thank you.